accelerated because you can see that this angle is a little bit steeper than this one, corrects, and then the final one to complete the motive phase, meaning get to the fifth wave, that gained $1,736, a 44.61% rise. That's a huge rise. And here's the interesting thing. The number of bars, this is a daily chart that it took, was 63 trading days, whereas the middle one took 109 trading days, and this first one took 83 trading days. So we had really a huge compression in terms of how quickly it got there. And although you can see that each rally peaks with almost a parabolic move here, almost a parabolic move here, it's undeniable the kind of parabolic move we saw at this fifth wave as gold's sitting at around 46.17 and pops all the way up. This is a wick which is being covered by a line above $4,600. And, I remember what it was like middle of 2011 when we watched gold basically go a little bit before that 1,000 and then to break 1,900. It was truly a historical time. And it doubled in price. Wave 2, and I believe we are in wave 3. Now, if wave 3 typically is not the shortest, it means that at minimum, we're going on wave 1, which is called the benchmark wave, from 4,200 to 4,900, so about a $700 move. So if this has that same move, 4,500, I'm rounding down, would take us to 5,200. Right. And that would be a third wave. We would still have a fourth and then a fifth. And that's why I am so excited about this point in time, because we watched miracles happen literally when we saw gold move up the way it did. It was not a pleasant experience going through the correction, but I think you recall I even used the words, it was a needed expenditure of energy. It had to blow off some steam. Yeah. And I was glad that it happened. I not only believed that it was upcoming, but without it, we wouldn't get the kind of smooth wave counts and, more importantly, the smooth kinds of signals that we're getting. So I'm sorry, go on.
No. This is good, Gary, because, and I must say, over that time, I mean, you look at this chart, it's been a privilege to kind of cover the.
Gary is coming at gold from a completely different angle than Clive or David. No macroeconomics, no Fed policy, no debt cycles, just charts. Specifically, Elliott Wave theory applied to gold's price structure. His argument is this: gold has just completed a massive 5-wave motive phase, and we are now entering wave 3 of a larger degree cycle. In Elliott Wave terms, wave 3 is almost always the longest and most powerful wave. His benchmark from the prior wave 1 move, roughly $700, projects a minimum target of around $5,200 from the current base near $4,500. But that's just wave 3. After that comes wave 4 correction and then wave 5 to complete the cycle. His year-end target is $6,000. He also makes an interesting secondary observation. Each successive rally in gold has been compressing in time. The first wave took 83 trading days. The second took 109. The fifth took only 63.
It doesn't seem all that unlikely to me. I mean, this has not been a meek market. We've just had new record high after new record high. Yeah. We've had phenomenal rallies. We've had rallies when we expected it. We had rallies when we didn't expect it. In other words, there were quite a few paradigm shifts along the way. Mm-hmm. Difficult to explain, but they were there nonetheless. That gold would typically react in one way, and now it was reacting in another way to that same information. And it's the paradigm shifts that have been most interesting. But what I find as one of the interesting paradigm shifts that we're currently witnessing, it does appear as though we're getting closer to some sort of resolution or peace. The latest talk was Trump wants a 30-day truce in which they negotiate the hard points with the idea at the end of the 30 days that they come out of these negotiations with some sort of a plan to end the war. And you would think that that would maybe drive gold down tremendously harder. But yet, during this whole process, and let's go blow this up. This is what we've witnessed. We've witnessed gold move from about 4,200 back up to 4,800 and a very, very shallow retracement. Okay. We are living in interesting times. I think the last time we talked, either we had just gone to the all-time record high or had already begun a price correction from that price point. And when I looked back at the way the rally unfolded and saw that there was a sister rally almost identical before that, and then I looked at the correction that we were having, it genuinely made me realize that the fractal nature of Elliott Wave, meaning in essence, it's a theory based upon market psychology that proposes that markets don't move straight up or straight down. In a bullish scenario, you will have a motive phase that have 5 total waves, 1, 2, 3, 4, 5, in which 1, 3, and 5 are what we call the motive phase. They trend in the prevalent trend direction. They move in the prevalent trend direction. In between that, 2 and 4 are called the corrective waves. When those 5 are complete, you enter some sort of a correction. Simplest format is an ABC, but you can have a compression triangle. There's quite a few distinctions in pattern types for how a market will correct. The important thing is, I'm assuming these are all-time record levels, and I know that my clients, we don't really address GDX, but I get a lot of questions about it. If you look back to see what it was doing, and I'll just pull it back as far as, say, 2016, you get some moves. But for the most part, it's very steady. It tends to pop up. It's nothing like what we're witnessing here, where it starts at $35 and then goes to 116. This is a market that's trading in a range-bound trading range. That all shifted about March of 2024 and accelerated in December of last year.
Hey, Gary, let's leave the viewers this time around with a little bit of a map. I mean, if your $6,000 gold target is going to play out by year end, what are kind of a few levels maybe that matter most right now that you're watching very, very closely for? You know, it could be support, breakout, confirmation, or even invalidation.
No, I'll look at everything. The first thing is, once we can identify the correction is completed, this first rally is a wave 1. Most importantly, it's called a benchmark wave, meaning we don't have hard figures to ascertain how high it will move because it's the first out of 5. But once this is in place, prices got a little overbought. They're getting a little top heavy. That's typically when we go in and liquidate, pull profits, or aggressive ones will go in and short the market. So it becomes kind of a self-fulfilling prophecy, but at the same time, it seems to be the normal pattern in which price moves over time in many commodities, trending commodities. Some of the commodities, such as cattle and other things, are work off a tight cycle because of especially grains. You put them in the ground at a certain time, you pick the crop at a certain time, so they tend to stay within a band. I look at gold or the precious metals as running more like stocks or real estate. It's a linear line up. It's simply a matter of how long it takes to get to the next level and how much damage was done.
Let me break Gary's analysis into 3 parts. First, the Elliott Wave framework and why it matters here. Most gold commentary right now is macro-driven inflation, Fed policy, dollar weakness, central bank buying. Gary is doing something different. He's saying the price structure itself is telling you what's coming, independent of the news. That's actually a powerful complement to the macro case. When technical structure and macro fundamentals align and point in the same direction, the conviction level goes up significantly. The specific structure he's describing, 5 waves up, completing a motive phase, followed by a correction that held key levels. Now, launching into a larger wave 3 is a textbook Elliott setup, and the compression he points to is important. When successive waves take less time to cover more ground, it signals accelerating momentum and rising participation. The market is not slowing down, it's speeding up. Current context. As of May, 2026. Gold has already broken through $4,800 and is trading near all-time highs after pulling back from the January 2026 peak around 5,500. The shallow retracement Gary references from roughly 4,200 back up toward 4,800 fits his corrective wave narrative precisely. The market held where it needed to hold. Second, the GDX observation and what it signals. Gary briefly touches on gold miners, specifically GDX, and notes something important. From 2016 through early 2024, GDX traded in a relatively tight range, lots of noise, not much progress. Then in March 2024, everything changed. GDX broke out and went from $35 to $116. That kind of structural breakout in miners, which are leveraged plays on the gold price, typically confirms that the underlying move in gold is real and sustained, not a temporary spike driven by safe haven flows. This matters because miners price in future gold prices. When miners accelerate, the market is telling you that sophisticated investors expect the gold price to keep rising. It's a confirmation signal, not a leading one, but it's an important one. Third, the $6,000 target and the roadmap. What Gary adds to the conversation that Clive and David don't is technical confirmation. Clive gives you the macro demand signal. People can't get into gold shops. David gives you the macro risk framework, debt, bust, money printing. Gary gives you the chart structure that says the price itself agrees with both of them. When all three lenses point the same direction, that's when markets tend to do their most dramatic moves. The disagreement is only in the magnitude and the timing. On direction, these three analysts are all saying the same thing. Gold is going higher and the move is not over.